Hello, clients and friends of the Center. Welcome to our last investment update on 2022. It's been an extremely eventful year after two surprisingly good years in 2020 and 2021. Diversified portfolios have not been immune to this pain, with stocks and bonds both being negative for 12-month returns. This is exceptionally rare and has only occurred in 2.4% of 12-month rolling periods in the past 45 years. The Federal Reserve has raised interest rates 7 times in 2022 to combat inflation. This year's sharp increase in rates and thus negative performance in bonds has been an anomaly and is unlikely to repeat. Volatility was driven by a variety of factors, including a Russia-Ukraine conflict that has lasted far longer than anyone had predicted, inflation that is retracing its steps stubbornly slow, interest rate increases, China's zero COVID policy, and extreme cryptocurrency downside. There was an election this year, and the result was a split Congress, suggesting there will be no major legislation this year. Gridlock is usually okay for markets. Looking ahead at 2023, inflation will likely continue to slowly cool. Oil prices have actually fallen into negative territory year over year, and this is the first time that that's happened since early 2021. That has certainly helped relieve inflation pressures already and will continue to do so. Supply chains are functioning much better too, which should help. Inflation has been a major factor in forcing the Federal Reserve to play catch-up this year with interest rate increases. This has caused a historical year for bond returns, and not in a good way. The Bloomberg U.S. Aggregate Bond Index was down 13% for 2022, and that followed a somewhat negative year in 2021 as well. This is a great chart to show what an anomaly that has been historically. A bar extending above zero indicates a positive year of performance, while a bar below zero indicates a negative year. When looking back to the late 70s, you can see that there has never been a negative year like this. There's also never been a year where the Federal Reserve has raised rates so aggressively, so quickly. The dots you see below the bars show how far bonds were negative at any given point during the year. So even when looking intra-year, bonds have never been so negative as they were last year. Prior to this year, the worst individual year for bonds was 1994. What is interesting to pay particular attention to is the following year, 1995, and the returns that occurred there. If interest rates increases subside as we think they will, bonds are now left paying a much better interest rate going forward at a minimum. Regardless, bonds still earn a spot in a diversified portfolio, especially now with interest rates so attractive. Getting in the habit of predicting the path of interest rates can be very dangerous though. I like to look at how good the experts are at predicting future interest rates. The chart below shows red what industry experts were predicting the path of interest rates to be, and the blue line shows actually what happened. Often it's a very different outcome than is expected. I think it's important to remember how inaccurate forecasts can be, especially this time of year when many headlines are sharing various experts either positive or negative projections. We stress process over prediction here at the Center. If you'd like to discuss our process in more detail, don't hesitate to reach out. Also keep an eye out for an invite to our February investment event. We're hosting both a virtual and an in-person event. Thank you.